I was sort of a blank slate at that time. I had dispensed with the idea that I could run this with discretionary management, but I hadn't yet found the revelation of systematic thinking. But I was very open to new ideas.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. We've got a great show this week. I'm joined by Adam Butler. Adam is the CIO of Resolve Asset Management, where he manages systematic quant strategies. He's also the co-host of the Gestalt University podcast. He just dropped a masterclass series and is the host of Resolve Riffs, which, by the way, there's a great episode you should catch of that one, which includes me. But they are all fantastic shows. We're going to talk about investment frameworks and how Adam learned to adopt a systematic process. We're going to hear about cutting-edge strategies such as risk parity, factor investing, and more. Adam, thank you for joining the podcast.
Hey, thanks for having me. We had a really fun time on Riffs that time, and I know there was a lot unsaid, so I'm looking forward to exploring some new directions today.
Yeah, it's just a great format with you and Mike and Rodrigo and the whole team. The way you've been able to have a casual and fun conversation that's also very substantive at the same time. It's fun and it's informative. It's something that I aim for in this show, and I think you guys really nail it and do a great job with it. So I highly recommend people check out the podcast, but I want to talk today about you and your story. And your early career was adventurous, to say the least. I'm just going to let you tell the story about your earliest years starting your career in finance.
Well, let me start by saying that I never had any intention of going into finance. I grew up surrounded by physicians and I guess to some lesser degree, lawyers and accountants. And I sort of stumbled on investing in my third year of university. And it was during a bit of a mini mining boom. So a couple of guys in my residence, we kind of got together and started picking stocks on bulletin boards or guided by bulletin board conversations. And we ended up next year raising some money from our housemates. And that was like $4,000 or $5,000 because we really thought we could triple it, quadruple it. And 6 months later, we gave back a small fraction of what our friends' parents or housemates' parents had given us to invest. So that was sort of one of the first lessons, but it didn't discourage me. And then I ended up, I actually was doing psychology in school because I thought I wanted to be, first of all, I thought I wanted to be a doctor, psychiatrist. And then later on, I thought I might want to do psychology. And then I kind of discovered the markets and went off on that path. But I was still in the psych program and I decided that I was going to sign up for this trading competition, which I did. And it was great. You could, they would just started these online trading platforms, right? These electronic trading platforms in Canada. It was sort of TD Greenline was the sponsor. And you could trade stocks and options to your heart's content. And the objective was to turn $500,000 in fake capital into the most you could make over a 3-month period. And I just traded my brains out, mostly out of the money options, mostly long and in tech stocks. And it was mid to late 90s. So you could kind of throw darts at the NASDAQ bulletin board and just get multi-baggers all day long, especially trading out of the money options. So I ended up turning $500,000 into whatever, 1.4 million in the span of 3 months. And I won the competition. And I signed up for the next one and I won that. And I came third in that competition. And so I got interviewed by the newspaper, and it was a good fun rivalry because the psych department got to brag to the commerce boys about the fact that one of their own had beaten them at their own game because several of the commerce classes had signed up for the same competitions to learn the fundamentals of investing. So, I was in the newspaper. So I was able to sort of create this dossier, this file, and I used that file to try to lever into some interviews on some of the big Canadian bank trading floors. And I ended up getting one, which is a bit of a story in itself.
And that was back in about, 1997, 1998?
Yeah, pretty close. 96 was the year that I won or came close. I won the first competition, came third in the second one. And I started interviewing in the summer of 97 for positions in on the trading floor of these banks. And it's funny because the day that I rode down on the train to have my interview in Toronto, I didn't realize it at the time, but when I went up to the 65th floor of the bank, which is where the trading floor was, and when I walked onto the trading floor, it was mayhem. And what I didn't know was that a company that had been halted for many weeks, a company by the name of Brex, had just started trading again that day. And this was important because Brex for the past couple of years had been a Canadian darling gold mining stock. They had this huge ostensible discovery in Indonesia. And it was one of the largest gold mining and highest concentration gold and copper mining operations that had been discovered in decades. And then this had been this huge profit center for two or three of the major Canadian banks. You know, they'd underwritten a lot of the issues and raised a lot of capital. And the company had made a lot of people in Canada very, very wealthy who were close to the deals. And it ended up turning out that the entire thing was a fraud. The people who had discovered the deposit and had been promoting it had salted the core samples and had vastly overstated the size of the deposit and the concentration of the ores. And so when this was discovered, this is a stock that was trading well above $100, and they discovered it was a fraud, and it traded down by 70, 80%. And the stock was halted so that it could be investigated. And it was this whole big drama. The founder of the company was thrown out of a helicopter in Indonesia. And so there was all kinds of grisly drama. But anyways, they had just reopened trading for this stock on the day that I went in to interview. So the entire trading floor was in this crazy uproar. And so I sort of sat in the middle of the trading floor and waited for the MD who had invited me to come and interview to have 5 minutes to spare to sit with me. And I was very concerned because I didn't think that I was going to get any time from any of these MDs that I was supposed to be interviewing with in order to, pitch my case and tell them why I thought I'd be a great candidate. I ended up sitting with 12 or 13 people, most of whom had absolutely zero interest in their time with me. They maybe gave me an obligatory 2 or 3 minutes and went on their way. And at the end of it, just the MD that had invited me to interview took pity on me and invited me to join his own team. So that's where I spent the next 18 months of my life.
Those jobs, those trading floor jobs were so hard to get and they were so coveted. And, the trading floor itself was just such an amazing place of energy. I spent years working at the New York Stock Exchange, and I was working upstairs. I was in an office with other people and working on market structure issues and working with ETF issuers. But when I had meetings, very often we'd have, walking or standing meetings down on the trading floor. It was just more fun. And there were times where I would just go down and just to, soak it in and see, the traders. It's such an amazing thing. And I really hope we don't lose it, that there's still at least a couple trading floors left out there. We'll see what happens with the NYSE after COVID when things open up. But I really hope they return to the trading floor model. I mean, it's just such an amazing place.
I agree. And it's a really amazing energy. And you learn, I swear to God, 12 months working as a trader on the trading floor is equivalent to 5 years of experience in most positions. So there's definitely some advantages to that model. It's definitely also got some downsides. I mean, it was a total frat boy club. I mean, it's inconceivable to think of now, but I mean, there were, I want to say 60 or 70 people on that trading floor. There were 2 women, and it was, any woman walked onto the trading floor and it's 68 men and 2 women. And, they were catcalled and whistled at. And it was, the boys were animals. Like they were trained to be animals just by virtue of the job, right? You've got to be ruthless and just enormously competitive. It's not necessarily a job, certainly wasn't at the time, where an extremely high level of education and pedigree was advantageous, right? It was more sort of street smarts, connections, aggressiveness. And so it just was very uncivilized, right? But that was part of what gave it an appeal, right? For a young guy, I obviously really liked the energy. I learned a lot. And, I think a lot of those dimensions needed an overhaul, and it's gotten them. And I'm sure something is lost in the process, but overall, I'm sure we're better off for it.
Sure. But I mean, it was what it was. And you show up at a late 90s trading floor full of hubris because you just won your stock competitions, right? So I'm sure, the usual overconfidence that we have, as young men, I think, was probably even amplified, I'm guessing. So how did that go? How was your first foray into investing?
Oh man. Yeah. I mean, you absolutely nailed it. So I am cock of the walk. I've just won a couple of trading competitions. I think in my mind that I actually turned $500,000 into 1.4 million in 6 months. And I just come third in the second competition. And so I walked in there thinking that I could do no wrong. I had a hot hand. And, I started out not even being able to trade, right? I mean, you got to get certified in the trading terminal, which took a few months. And then you got to get certified by the regulators, which took another few months. Eventually I was certified and I was able to trade. Keep in mind, the model for the desk that I was on was to generate trade ideas for the retail advisor group. So there were about, I want to say 800 advisors across Canada. And the vast majority of them still made money by churning the book, right? By commissions. You're earning commissions from when people buy and sell stocks and bonds. And so we were coming up with ideas, reasons why investors should sell this stock and switch into this stock. And it was partly informed by, simple technical analysis, some fundamental analysis, and to a meaningful extent, just the availability of blocks that came through the institutional desk, right? The institutional guys are constantly bidding on blocks. Either they're looking to take it down or they're looking to offload it. And so there was a board you could look at, and we had a list of stocks that we had our eye on that we were hoping they were going to be listed on the institutional board. And when they did, we'd say, "Yep, we'll take half that, or we'll take the whole thing down." We would hold that in our omnibus account, and then we would get to work. We get on the squawk box and say, "All right, we got a block of this and a block of this. We think you should be switching out of Royal Bank and into CIBC for this list of 5 reasons. This is how you articulate it to clients." Or, we think you should be switching out of this mining stock or steel stock and into this mining stock or steel stock, or this sector to that sector. And then the advisors would start calling, right? And so they call to say, "Yep, I've got 50,000 shares of this on my book. I'm going to call all my clients and sell all those down over the next week and switch into this other company. And so just book that for me and I'll send you tickets." So we would hold that stock in our omnibus account, and then they would have the opportunity to send tickets down over the next week as they made their calls to clients, which is just astonishing when you think about it today, because it gave the opportunity to these advisors to call a lot of the time in a rising market and say, "Listen, we're going to make this switch. And by the way, we're able to, buy this new stock for you at 10 or 15 or 20 cents below current market. So we're giving you an instant profit," right? And so all this was allowed at the time. But in addition, we had this omnibus account that you were able to trade. The idea was to sort of stay fresh and stay with the game and stay in the flow. And you could also generate P&L within this omnibus account. And I could trade anything within it. So I was trading stocks and doing the same kind of trades that I was doing when I won the trading competition. And that ended up working really well for a while. They don't start you off. They had a $2 million omnibus account. They don't start you off with a $2 million risk budget, but they started me off with $100,000. And then I threw some darts and I turned that into a couple $100,000, and I threw some more darts, and then they upped their risk budget, threw a bunch of more darts. And before you knew it, in sort of 15 months, I had turned this omnibus account from $2 million to about $8 million. And just thought I could do no wrong. And I remember there was an occasion when one of the major Canadian banks came out and said they were going to try and buy this other major Canadian bank. And the market went crazy. And there was this whole Canadian bank mergers frenzy. And all of the Canadian banks rose in anticipation of this merger wave. And we were waiting on the regulators to weigh in. And then I remember after the first merger announcement, all the bank stocks went up massively. And then there was a second merger announcement. And then in the pre-market, the target went up another 10%. And I just said, "This is rubbish. This is already priced in. We're going to get a massive fade on the open here. This is a total sell the news." And we went in and shorted this in the pre-market in size and made this massive windfall profit as it dropped on the open. We covered. And I remember being carried around the trading floor on that day. We had this inflatable Burger King crown. So they put this inflatable Burger King crown on me and paraded me around the trading floor. It was just, but these were the days, right? And so you can imagine that sort of max hubris. And it wasn't long, maybe like 6 or 8 weeks later, when I learned my first major lesson in my investment career.
And what was that?
Well, you might recall, I think we're about the same age, and you might recall this. So this was the summer of 98 when all this was going on, or spring and summer 98. And so in the fall of 98, so call it August, September, there was a cascading crisis. So there was the Thai baht devalued, and then there was a Russian sovereign debt default, and then there was the long-term capital management bailout, right? Because they were massively exposed with huge leverage to this Russian default, and markets just cratered, especially the big tech names, absolutely cratered, down 40-50% in the span of sort of 3-4 weeks. And I had a bunch of levered positions on, and a bunch of options positions on, and anyways, in the span of sort of 3-4 weeks, my $8 million profit turned into, I whittled it all the way down to sort of $1 million again. So lost about $7 million in just a few weeks, and a few weeks later was escorted off the trading floor. So
escorted off, literally.
Yeah. For taking on just way too much risk. Now, I mean, look, it is absolutely fair to say that there was just an egregious lack of supervision. Here you had a psych grad who won a couple of trading competitions, and purely by virtue of luck combined with way too much leverage and risk budget, had just happened to sort of accumulate massive P&L in a very short period of time. And my supervisors obviously should have been all over this, right? And they just weren't, and everyone was sort of caught up in the frenzy of it. But in the end, there needed to be a fall guy. And there was a lot of regulatory changes around then too. The whole idea of parceling out shares held in an omnibus account over many, many days to advisors as they made calls. And like all of this would be way offside today. So that, the model changes over time. But anyways, through a confluence of events, that desk basically went away. But this was sort of the catalyst to have me be the fall guy on this. And I learned a lot of really hard lessons, or a really hard lesson in the process. And it took me a few years to kind of regather and reorient it and come back to investing. But, that was a really valuable lesson in retrospect.
I mean, it's such a sudden fall, such a sudden shock to the system. I mean, how do you recover from that? How do you pick up the pieces? And do you just try to get back to what you were doing and do discretionary prop trading, or did you pivot in your career? I mean, where did you go from there?
Yeah, I totally pivoted. I went back to school and I did a certificate in programming. So I learned how to code in VB and Java at the time. And then I went to work at IBM. So I worked at IBM for a couple of years. And then I jumped from IBM to join an internet startup. And this would have been in 2001 or so. And 6 months later, the internet startup that I was working at went from about 150 people to 20 people in the span of about 6 months. And my wife at the time was working at a major management consulting company, and their primary internet practice group was based in Toronto. So they had massively grown that practice group over the previous 5 or 6 years, and that practice just got decimated as well. So my wife and I were left sort of going, what should we do here? It's a crappy job market. Do we want to continue to scramble here for a while, or do we want to make lemonade out of lemons? And decided that we'd go travel. So we spent a couple of years in Thailand teaching at this massive boys' school, 6,000 boys from kindergarten to grade 12. And I taught math and physics and science and English, actually, to boys in an English immersion program from grade 7 to grade 10 for a couple of years, which was just an absolutely magnificent experience. But while I was there, I decided I wanted to get my CFA and go back into finance. And so that's what I did. And when we came back, I went back into finance as an advisor, went through the retail broker training program at one of the Canadian banks, and got back into finance through that channel.
You're still a long way from where you are today, from quantitative and systematic processes. Help us make that connection then. So now you're back and you're studying for your CFA, you're becoming a financial advisor. How did you then, what's the missing gap between that and, being a quant?
I'm firmly of the belief that so much of what happens to you is a function of luck. And it just happens that my wife and I honeymooned in Antigua. And as we were riding from the airport to the resort on the van, we rode in with another couple that we ended up spending the entire week with. And his family was one of the old stone families built half of one of the cities in northern Alberta, and like an old construction family, an engineering family, and had construction programs all over Hawaii and the Caribbean and whatever. And while we were down there, I was sort of talking to him about my passion and what I was working on. And they were thinking about transitioning their wealth management to somebody. So I ended up, when I went back into wealth management, I reconnected with him, and over the course of 6 or 12 months, they ended up just placing their faith entirely in me as their core wealth consigliere. And so that obviously was a huge leg up. And they had a certain way that they wanted their wealth managed, which required me to be a discretionary portfolio manager. And it turns out that at the time, that was very hard to get a license to be a discretionary portfolio manager at a typical bank brokerage, especially just when you join, right? It takes would have taken 5 years and 2 years, I think it was 3 years with a CFA, plus you had to have a book of a certain size. And I just didn't meet half of those criteria, but it was a hard criteria for my benefactor family. And so I ended up looking around for a new home that had a platform to support portfolio managers and discretionary portfolio management. So I was living in Ottawa at the time. My wife was going through an education degree because she really wanted to be a teacher. So I started my FA practice in Ottawa, but I ended up looking back to Toronto to find a home where I could have the portfolio management practice in a way I wanted. And I ended up finding more of a boutique shop in Toronto. And that is where I met my current business partner, Mike Philbrick, who was the branch manager at that boutique shop. And, I came in, I had a small number of clients, but a fairly sizable book of business. I was running at the time a relatively sophisticated discretionary practice. Even at the boutique firm, there was a very small number of advisors who were doing that. So I ended up sort of leading the charge on that, or helping to guide the template for how they would roll out that program at that boutique firm. And I had no administrative staff to work with. And so I ended up just using or joining Mike's sort of team informally to make use of his administrative team, because he was a practicing advisor at the time. So had a book that he was managing, but he also had this branch manager role. So his administrative group was a little larger than maybe he needed. And I didn't have a huge amount of administrative work. So we got together kind of under that pretext. And over time, we just discovered that we had very symbiotic passions and talents and focuses. And we ended up coming together formally as a team about a year or two later. And then our team sort of developed from there when we had some experiences in 07, 08 that I think caused us to course correct and pivot very substantially in our thinking. And then we went off on that trajectory together.
I want to talk more about that, about the change in mindset and philosophy that you had. I know that you were very inspired by Nassim Taleb, as well as Philip Teplock, and we'll talk maybe a little bit about Meb Faber, but Taleb especially. Skin in the Game came out. I'd already left the corporate world to start my first startup when that came out, and that book put so much into words that I had been feeling that were like things that were bubbling up inside me about having skin in the game and putting your name on the door and just countless things. Tell me a little bit about, how, Taleb had maybe inspired you or Philip Teplock and Meb, and how they impacted your thinking. And then, what was that change in philosophy?
Yeah. So, just to put a pin in the skin in the game comment, because I know a big focus of our conversation on Riffs was around your entrepreneurial experience, right? And there are very few types of positions that necessitate more of a skin in the game mindset than entrepreneurship, right? So I know I can see how that must have really resonated with you and informed how you sort of think about the world. So I just wanted to make sure we got that, because that I connected the dots on that from our own conversation. But for me, just by way of background, I was running a discretionary portfolio management practice for this small group of clients, which allowed me to be very nimble, right? Because I didn't need to call clients every time I made a change in their portfolio. And it allowed me to spend the vast majority of my time researching and kind of writing reports and writing commentaries and just to sort of crystallize my thinking. But it was all sort of on the theme of global macro. And I don't know if you remember at the time, the zeitgeist at the time was around the emergence of the emerging market middle class, right? It was the BRICS, the rise of the middle class in Brazil and Russia and India and China, and what that was going to do for the consumption of raw materials, specifically metals and energies. And there's this whole theme on how the Saudi oil fields had already peaked, and that the marginal increase in production was going to begin to decline over time. And then there was the peak oil, and then there was peak food production and all the inputs to food production. So, potash and phosphates and all that kind of stuff. So I went right down the rabbit hole on the supply to demand dynamics within the food industry, within the energy industry, and trading different dimensions of the energy markets from drillers and the exploration companies through refiners and the major production companies and companies with different types of refined products and qualities of crude products and all that kind of stuff. So I went right down the global macro rabbit hole. And at the same time, I was very aware of the acute crisis that was building in the US banking system and in the global banking system as a function of the issuance of all of these bad loans and CLOs and CLO squareds. So I was running this global macro book, which was massive longs in this emerging market middle class theme, and a bunch of shorts and puts on a lot of the big sort of money setter US banks, Fannie, Freddie, that sort of stuff. So coming into kind of 2007, 2008, I'd racked up some really great profits. I thought that I had a really good handle on this by virtue of just having an edge in terms of informational knowledge or advantage and asymmetry. And then 2008 happened, and I realized that I knew very little. And all of the knowledge that I did have didn't really matter when everything kind of went down together. And I hadn't given nearly enough thought to the position sizing on my hedge book, the concentration in my long book. And I was just vastly overconfident in how well my knowledge should be able to inform my portfolio positioning. And it ended up being just a really difficult time. So none of my knowledge really helped. And coming out of that, I just didn't want to go through that again. And it had been a really rude awakening in terms of the value that I was able to bring to the investment process. And it completely challenged my discretionary views and the fact that you could inform portfolio management using discretionary views. And so I was sort of a blank slate at that time. I had dispensed with the idea that I could run this with discretionary management, but I hadn't yet found the revelation of systematic thinking. But I was very open to new ideas. And it was at that time that I stumbled on Fooled by Randomness and Black Swan by Taleb. And Fooled by Randomness really resonated in terms of the narrative fallacy, right, and complexity. And the Black Swan, obviously, in terms of most of the important things that happen in investing, but also just in life, come down to where you are and how you're positioned during these very, very rare but massively impactful moments in time that can't really be predicted in advance. And at the same time, I was stumbling on this idea of systematic thinking, and I listened to originally this talk by Philip Tetlock, and he had sort of summarized his findings from a longitudinal experiment that he'd been doing over the last 10 or 12 years. And he published their findings in his book called Expert Political Judgment. And the findings from that book were just an unbelievable revelation for me at the time in terms of what was possible for systematic decision-making within complex fields. And that drove me to the realization that systematic thinking was really the only way to navigate complex domains like markets. And then just to the point about Meb Faber, I sort of stumbled on Meb's original paper on global tactical asset allocation, which was a really simple systematic strategy based on, a 10-month moving average. And the power of that led to an entire new domain of research and thinking and eventually to the launch of Resolve many years later.
Today, now, I'd say you're a thought leader, an expert on quantitative strategies. You just wrote a great white paper on risk parity. It's an incredible thing how you've been able to take that leadership position in, a somewhat short amount of time. But let's talk a little bit about risk parity. I feel like this is a strategy that has not yet been mainstreamed, but is on the verge of doing so. And in my opinion, if not for the concentrated pile-in U.S. large cap and in technology, and if that ever, which I'm losing faith, but if that ever retracts a little bit, then I think we might see risk parity become even a mainstream asset allocation approach. Tell us a little bit about what risk parity is and a little bit of the findings of your paper.
Yeah, I mean, in the context of sort of systematic thinking, you've got sort of the inside view and the outside view, right? Michael Mauboussin does a great job of describing this in terms of decision theory. And when you're really close to a domain, it is really hard to set aside your domain knowledge and back up to 40,000 feet and think, what are the base probability distributions that I'm dealing with here, right? So as an example, I was deep down the rabbit hole in terms of my understanding and expertise in the emerging market and commodity space and in the U.S. banking and debt sectors in 2007, 2008. But what I wasn't aware of is the outside view, which is just how hard it is to be successful in active investing and in taking active views in markets, right? If you look across all active funds, I mean, if you just use the active mutual fund space, the probability that an active fund outperforms a passive fund over any meaningful time horizon is just vanishingly small. If you go out to sort of the 10-year horizon, there's actually a smaller number of managers that outperform passive indices than might be expected from pure randomness, right? So it's just a really hard thing to do. So the outside view is take your active views with a very large pinch of salt, right? So if you want to sort of start with the outside view, it's what if I don't know anything? What is the global passive portfolio, right? And what assumptions do you want to make in order to create this portfolio? So one potential option, which was first proposed by Sharpe in a paper in 1962, is the global market cap weighted portfolio, which is informed by the efficient market hypothesis and just basically says if markets are efficient, then all information is priced in the market and all securities trade at the right price and therefore, therefore at the right valuation. And if all securities are priced at the right valuation, then you should just hold all securities at the right valuation and assume that the market has taken into account all of the opportunities for diversification. So if you do that, then that's the global market cap weighted portfolio. And a team led by Swinkles back in 2014 actually did all the research on the character and profile of the global market portfolio. And we've written fairly extensively on that as an option, perfectly reasonable option for investors who want to take a truly passive view, right? But I think that there's reason to think that maybe the global market cap weighted portfolio, rather than being an expression of efficiency, is an expression of the individual biases and arbitrage opportunities that exist across boundaries. So for example, we know that investors are biased to want to invest in companies and bonds in their home markets. So Canadians, on average, a Canadian investor will hold about 70 to 80% of their portfolio in Canadian equities, even though Canadian equities only represent about 2% of global market cap. Well, if every country does that around the world, then obviously that you're expressing an aggregation of biases, not an aggregation of efficiencies, right? People are obviously trying to take advantage of tax opportunities. There's a franking tax rule in Australia that very heavily motivates Australians to invest in in Australian companies, right? Because they get very preferential tax treatment on Australian dividends. So there's all these different idiosyncratic rules and biases that drive people to make very inefficient rules in terms of their global portfolio, or at least their portfolio objectives are not informed by the objective to have a global passive, the optimal global passive portfolio, right? So if you look at that as the global market cap weighted portfolio as more of an expression of biases and tax arbitrages than an expression of efficiency, then you sort of think, well, how can you express a slightly different model-based view that accounts for all of the global investment opportunities that the global market has to offer? And global risk parity is just another model-based asset allocation program that takes the very simple view that the unbiased or unconditional expected return of broad global asset classes is broadly a linear function of their risk. And that volatility is typically a reasonable proxy for risk over the very long term, right? So if you take that view, then basically you're saying that all major global asset classes have the same long-term unconditional expected Sharpe ratio. And therefore, by extension, you should simply seek to maximize diversification across all of the major global markets. And if you maximize diversification, that ends up being the ex-ante most efficient portfolio, the max Sharpe portfolio. So it's simply another model-based alternative to the global market portfolio for investors who want to purely rely on the outside view that they don't have any skill and they just want to capitalize on all the world has to offer with the maximum amount of efficiency.
Yeah, and it makes a lot more sense to me, at least, than does traditional market cap weighting, saying that the efficient market hypothesis is true. When we're looking at stocks, Tesla blows around $30 billion in market cap every day. I don't know how you can call that efficient. But, with risk parity, you're diversifying not just the dollars by asset class, but you're diversifying by the risk. And I think that's, kind of the real brilliance of it. And, just as an aside, when you talk about the inefficiencies of market cap weighting, I've expressed that with reverse market, or what I call reverse market cap weighting, which is just the reciprocal of the market cap. If you take 1 minus the cap weighting for an index, right? You try to take the other side of that missing alpha, right? Typically it'll show up in value funds or quality funds or different factors that you can use. But to me, the most simple way is just to take the reciprocal of the market cap and weight everything bottom up instead of top down and try to capture that. But there's a long period where that strategy and many other factor strategies that try to give you a more efficient exposure than does market cap weighting in equities, where they've just underperformed for years. There was just this massive steady beat of flows into cap-weighted passive indexes, and that may or may not be the driver. It might be the runaway valuations of the companies at the top, but for whatever reason, all those strategies were underperforming for years. Now we're starting to see that turn. But in the heart of it, about a year ago, you put out a great line on Twitter. You said that alpha lives where most people don't want to go. And this is at a time when everyone was piling into big tech at the top, at the relative top to other factors. Tell me a little bit about that.
Well, a really good anecdote here is I remember sitting in a room with Bob Shiller, Dr. Bob Shiller, who's the progenitor of the CAPE ratio and won the Nobel Prize for his contributions in economics and is a big proponent of behavioral economics. And I remember him sort of going through the process of describing how U.S. equity markets were extremely expensive by a wide variety of reasonable measures. And at the end of his presentation, having a discussion where people were asking questions. Well, Dr. Shiller, it seems like there's nowhere that's reasonable to invest or that you can possibly capture the required return that my investors need for their financial objectives. And Bob Shiller said, no, that's absolutely patently not true. If you look at places like Turkey or Russia or Czech Republic or, and he rhymed off, a handful of these small emerging markets or frontier markets, all trading at very low single-digit multiples relative to large cap U.S. equities trading at very near record multiples, depending on the metric. All of these markets are priced for low to medium teen annualized returns over the next 10 to 15 years. Raise your hand if you're going to go out tomorrow and put the vast majority of your client portfolios into Russian and Czech ETFs. And everyone kind of laughed, right? And no one raised their hand. But that's just a really simple example of how alpha lives where you don't want to go. And I mean, a certain amount of this is sort of taking a bit of a loose definition of alpha, which I've also written about and spoken about. But alpha is different for different constituencies, right? What Two Sigma or Rentec might consider alpha is different than what a relatively novice retail investor might consider alpha, right? So I'd say alpha is whatever you can't do yourself, right? Or what is not readily available in the market for essentially for free, right? So if you don't know, if you're a retail investor and your analysis, you don't have the skill set or the breadth of information to be able to observe that investing in Czech stocks or Russian stocks or whatever have you probably represent a massive 10% a year expected premium return over the next 10 or 15 years, then an advisor who's able to point that out and guide you to investing in those areas is, I think, delivering alpha, right? And there's also, there's a variety of other ways of delivering alpha. If you're, I think for a lot of investors, just a simple global risk parity portfolio is delivering alpha because they would not have thought to think about the problem in that way. They wouldn't have the expertise to invest in diverse global futures, to manage the leverage and the margin and the risk budgets, et cetera, to optimize the portfolio, to maximize diversification. There's an enormous amount of expertise that goes into that. And that expertise is alpha. And it may not look like alpha in the short term, right? Because as you said, over the last 10 years, any effort to diversify away from large cap US growth has been enormously deleterious to ex post returns, right? So if you want to look backwards and as Andy Duke says, perform a resulting experiment, then basically every global advisor who was giving prudent advice 10 years ago looks like a moron and looks egregiously irresponsible, right? But the fact is that very, very few people, and I would argue literally zero people, knew 10 years ago with 100% confidence that US large cap growth was going to suck the oxygen out of global markets to the extent that it has, right? And if you look back through history, there is literally zero examples where this type of dynamic was experienced with such an extreme magnitude over a 10-year horizon where that did not mean revert very painfully over the next 10 or 15 years. And I think, we certainly have every expectation that this current massive growth dynamic will revert either by going sideways for the next 10 or 15 years or by delivering just a tremendous loss in the short term that will take a very long time to make up. So we're obviously very bullish on diversification at the moment. But to be fair, we've been bullish on diversification for the past 7 or 8 years and suffered somewhat from that view. But as each year goes by and as the dispersion becomes more and more extreme between US large cap growth and every other global market, and we observe the multiples on US large cap growth grow to the sky, then our conviction in that mean reversion obviously grows more and more. So I think the next 10 years is going to reward diversification in ways that most people couldn't even conceive of at the moment, given the experience over the past 10 years. We're looking forward to that.
Over the last several years, whoever has been furthest out on the risk spectrum has had the best performance and has been rewarded and therefore emboldened by their actions. You look at the fixed income market, and as soon as we hit trouble last year in the high yield, that the Fed comes in and starts buying everything up and again, reinforcing that behavior. And it's very much, I share that concern. But I want to have time here for my closing question, which is, tell me an obstacle that you've had either in your personal life or in your career that you've either found a way to work around or just persisted through.
So, I sort of skipped over this when I was walking through the arc of my career, but I think this is probably the closest answer I could give to this question. But back in 2008, when I was going through this major crisis, and it was a crisis both in the markets and in my own sense of self-worth, because I had sort of marked my self-worth by my ability to navigate markets using my knowledge and analysis and my discretionary tool set. And when it was revealed beyond any doubt that I wasn't able to do that, then I didn't know what I was even doing there. I didn't know what my value was as an advisor. And I very seriously contemplated shifting out of finance completely. And I actually went to a therapist because I was just so depressed. I was depressed because I was having an existential crisis about my own sort of value in my chosen field. But also I was having a crisis about moral hazard and fairness. And, the irony is that I actually did really, really well during the acute crisis period in 2008. The shorts that I had and the puts that I had on European banks, Fannie, Freddie, et cetera, had offset a great deal of the losses in my commodity and emerging market oriented book. Where I really got smashed was when governments came in and changed the rules, and all of the banks and companies that should have gone under were bailed out. So there was a very visceral experience for me as I watched my hedges unwind and my portfolios take a second leg down on that. But also there was this feeling of unfairness. And then, of course, over the next several months, watching the C-suites at all these companies that had almost gone bankrupt pay out millions in bonuses to one another, really because they basically took transfers from the government and paid those out in bonuses to senior management across a wide swath of segments in the market. And I just was extremely disheartened. And so I went to talk to somebody about this, and they recommended, it was a cognitive behavioral therapist, and they recommended to try to navigate my way through this, I should write down my thinking. So that was what motivated me to start my blog. And so that I started the Gestalt U blog at that point. And one of my first articles was called Sirens in the Distance. And you can Google Gestalt U Sirens in the Distance. I think that's up there probably somewhere still. That was sort of a cathartic expression of my thinking at the time. And it was part sort of complaining and about all the ugliness and the unfairness and the moral hazard, and partly my sense of what the macroeconomic picture was going to look like. And it was, it's weird because the actual macroeconomic picture went on to be very, very close to what I had predicted at the time. But the market response to the macroeconomic picture was vastly different from what I had expected, because I never in my wildest dreams expected global central banks to continue to bring this largesse, this monetary largesse to global markets and continue to bail out risk takers in the way that they have. So over time, I've just tried to ignore it, right? If I get into conversations about this, I still get my blood pressure rises and I still get really angry and really depressed about the whole situation. But that allowed me to sort of move on. And then I started diving into systematic thinking and quantitative finance and solutions to this problem, which I think has been really cathartic. But that overcoming that major existential crisis and then moving into systematic thinking and quantitative finance and launching Resolve and building Resolve, I think that was probably the major pivot that was most influential and impactful for me.
Well, it's an incredible thing. And, I'm a big fan of everything you're doing, the podcast. You've got one of the best social feeds. Your Twitter feed is fantastic. It's just endless, great ideas and structured very value add and educationally. So I really appreciate that. Where can people follow your papers and hear your podcast and learn more about Resolve and your funds and everything else?
Please feel free to follow me. I'm at GestaltU. That's GESTALTU on Twitter. InvestResolve.com is where you're going to learn a lot more about Resolve Asset Management. We've got, going on 24 research papers on everything from retirement planning to asset allocation to efficient portfolios and stocks, obviously risk parity, the development of quantitative strategies and some of the nuanced dimensions of that whole exercise. And as you mentioned, we've got the Gestalt University podcast. We've got our Friday live YouTube broadcast, Resolve Riffs, RIFFS, which is also on a YouTube channel. And as you mentioned in the beginning, definitely encourage you to check out the Resolve Masterclass series. If you just Google Invest Resolve Masterclass, then you'll be taken to that podcast series. And we think that there's a lot of really valuable lessons for folks who are thinking about how to best position for long-term wealth management and, multi-generational. And that applies to both individuals and family offices and institutions. We sort of specialize in institutions less than about $10 billion under management, because once you go above kind of $10 billion, then you are very restricted in just the amount that you can, the type of active risk that you can take relative to the market. You sort of become the market. So anything sub 10 billion, we think there's a lot of valuable thinking in there, and we'd be keen for you to reach out with any questions or comments.
Well, thanks again, Adam. Thank you for joining the podcast. Thank you to the listeners for your time and attention. We will be back next week.
Thanks so much, Phil. This has been a lot of fun.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.